Hi everybody, Jeff Yastine for Total Wealth Insider. I have to tell you, I'm not surprised at all by the stock market's plunge in recent days. In my article, Making Money When the Party Ends, which we posted on Banyan Hill back in December, I noted the rising levels, record levels of bullishness among individual investors, and it was happening at the same time that institutional investors like pension funds and hedge funds were pulling back from the stock market because they recognized just how crazy things were getting. The caution signs are piling up, I noted in my article back then, and I said it's not a bad idea to take some money off the table. And I hope that you did, but the big question is now, what do you do? Well, I hate to say this, but after a drop of more than 2,000 Dow points in the last handful of days, it's a little late to turn into a super bear on the stock market. You know, these things don't go straight down. There's going to be a counter trend rally, and frankly, quite often we see yet another rally back up to the old highs and sometimes exceeding those old highs. And we have examples of that from stock market history. In March of 2000, the S&P 500 fell 11% in a matter of days as the dot-com boom came to an end and turned into a bust. And yet the S&P 500 by August of that same year was back up to within just a hair's breadth, about a half percentage point from making yet another new all-time highs. And of course, after that, there was a damaging bear market that began. In July of 2007, we saw the S&P 500 up 10% for the year, and yet from July to August, we had a decline that gave back all of those gains. And then from August through October, again in 2007, we saw the S&P 500 climb back up and set yet another new all-time high for the year, again, before we saw another damaging bear market. So I guess my overall point here is don't think of the current action as necessarily saying get out of the market now. Think of it as an extended warning sign, a red flag to shift your individual investments into safer areas, parts of the stock market that aren't as heavily overvalued as the Facebook type stocks that everybody's been chasing in recent months would have you note. So it's also a red flag about interest rates. Back in July of 2016, the U.S. Treasury 10-year note, which is sort of like the benchmark bond that everybody watches, that bond was yielding 1.36%, which was like an all-time low for that particular bond and really for interest rates in general. Since then, we've watched that 10-year note rise to 1.85% as of last week. And the overall meaning here is that interest rates have bottomed and they're beginning to move higher. And when that happens, we are going to see borrowing costs for both consumers and businesses go higher and higher. Now, that doesn't mean that the overall stock market has to crash. But what it means is that it becomes harder, and for companies that are used to borrowing to buy back stock and do other things to make their businesses look better than they really are, it becomes harder for them to do that. And of course, for consumers with higher interest rates, it means that many people may have to pull back on some of their purchases, like new houses and like buying new cars. And it means for us as individual investors that we need to take a better heed about stock market risks and move more of our portfolios over towards value-laden investments. I'm Jeff Yastine for Total Wealth Insider, and please keep liking us and watching us here on BanyanHill.com.